You have money in the bank right now. It is sitting there, safe, insured, earning little interest maybe. And every single month you check the balance and the number either stays the same or goes up. So here is the question nobody asks. What if the number going up is actually a lie? Not a fraud, not a scam, something far more elegant than that. Something so embedded in how modern economies work that most people will live their entire lives without ever fully understanding it. It is called inflation. And before you click away because you think you already know what inflation is, let me be direct. You probably know the word, but not the mechanism, not the math, and definitely not who it quietly benefits at your expense. This is not about prices going up at the grocery store. That is just the symptom. This is about a system that transfers real wealth silently from people who save to people who borrow, and does it every single day without anyone signing a document, without anyone pulling money from your account, and without a single news alert on your phone. Let us start with something concrete. Say it is 2020. You have worked hard. You have $50,000 in savings. You are being responsible. You are doing everything right. That $50,000 sits in a high-yield savings account, earning about 0.5% annually. A year later, you have $50,250. You feel fine. The number went up. But in that same year, inflation ran at roughly 1.4%. Then in 2021, it surged to 7%. Then it stayed elevated. And while the number in your account crept upward by fractions, the purchasing power of that money, meaning what it could actually buy in the real world, was collapsing. By the end of 2022, your $50,000 in buying power terms was closer to $44,000. No one took the $6,000. Your balance did not change, but the money you thought you had quietly ceased to exist. That is the quiet tax. Now here's where it gets interesting, because most people hear that and think, okay, prices go up, that's just how it works. Supply and demand. Costs of things rise, life gets expensive. And partly that's true, but inflation is not just a natural weather event. It's also a policy tool, and understanding who controls it and why is where the story actually starts. Central banks, specifically the Federal Reserve in the United States and equivalent institutions in nearly every country, have the legal authority to create money, not find it, not earn it, create it. They do this by adjusting interest rates, buying government bonds, and through a mechanism called quantitative easing, which is a deliberately complicated phrase for something relatively simple. The central bank creates new money electronically and uses it to purchase assets from banks. More money in the system, chasing the same amount of goods and services, means each individual unit of currency buys slightly less. This is not controversial economics. This is the mechanism. The debate is over how much of this is intentional versus accidental. But here's the part that does not get debated. A moderate level of inflation, typically around 2% annually, is the explicit stated target of most central banks. They don't want zero inflation. They want positive, persistent, low-grade inflation every year, forever. Which means the quiet tax is not a bug, it is the policy. Let's run the math slowly, because this is the part where it becomes uncomfortable. If the official inflation target is 2% per year, that means in 35 years, the purchasing power of a dollar is cut in half. Half. Not from a crash, not from a crisis, from the normal, intended functioning of the system. If you save $100,000 today and never touch it, and inflation averages 2% annually, you'll have $100,000 in your account in 35 years, but it will buy roughly $50,000 worth of what you can buy today. You did not lose the money, you lost the value. Now push that to the elevated inflation of 2021 and 2022, where it peaked above 9% in the United States. At 9% inflation, the purchasing power of your savings halves in approximately 8 years, not 35. 8. People who held cash during that period did not feel a crash. There was no Black Monday, no bank run. Their statements looked fine, but they were being quietly drained. Here's the irony that makes economists either laugh or go quiet depending on their mood. The people most hurt by inflation are almost without exception the people who were told saving was the responsible thing to do. Middle-class savers, retirees on fixed income, workers who kept cash because they were nervous about the market, people who didn't invest because they didn't trust Wall Street or couldn't afford the risk or simply didn't know how. These are the people inflation taxes most efficiently because they hold the currency. They do not hold the assets. And the people on the other side of that equation, the ones who borrowed, the ones who took out mortgages before rates jumped, or issued bonds, or ran leveraged businesses, they borrowed real money and are paying it back in dollars that are worth slightly less every year. In an inflationary environment, debt becomes cheaper over time in real terms. Savings become worth less. The saver is the one holding the bag. The borrower is the one quietly smiling. This is the part where governments enter the picture, and it gets a little darkly funny. Governments are almost always the largest borrowers in any economy. The United States national debt as of 2024 sits above $34 trillion. The interest on that debt alone runs over $1 trillion per year. Now consider, if inflation runs at 4%, the real value of that debt falls by 4% per year, not because anyone paid it down, not because anyone made hard choices, simply because the money it's denominated in is worth less. Inflation is functionally a partial default that never gets called a default. The government borrowed dollars that could buy a certain amount of things. It will repay those dollars, but the dollars it repays will buy less. The creditor, which in many cases is you, through pension funds, treasury bonds, savings accounts, absorbs that difference. This is not a conspiracy, it's just arithmetic, but it's arithmetic that tends not to get a segment on the evening news. So what does the hype say versus what is actually true? The hype, the comforting version of the story, goes like this. Inflation is temporary. Central banks will raise rates. Rates are a lever they can pull. Pull the lever, inflation comes down, problem solved. And to a degree, that's true. Rate hikes do cool inflation. The Fed proved this between 2022 and 2024 by aggressively raising the federal funds rate from near zero to above 5%. Inflation came down from its peak. But here's what does not come back: the purchasing power you lost during those 2 years. When inflation drops from 9% to 3%, that's not recovery. Prices do not fall. The level of prices stays elevated. They just stop rising as fast. Everything that cost 20% more in 2022 still costs 20% more in 2024. Disinflation, meaning slower inflation, is not deflation, meaning prices falling. The two sound adjacent. They are not. And the people who are waiting for things to return to normal are waiting for something the system is not designed to deliver. Zoom out for a moment because there's a bigger picture here that's worth sitting with. The global financial system is structurally dependent on mild, persistent inflation, not because economists are evil, because the alternative, deflation, meaning prices actually falling, is genuinely dangerous in a debt-based economy. When prices fall, people delay purchases, expecting further declines. Companies earn less. They cut workers. Workers spend less. Prices fall further. This is a deflationary spiral. Japan spent the better part of 3 decades trapped in one. So central banks err towards inflation, always slightly intentionally warm, which means the tax never quite stops. The people who understand this buy assets, real estate, equities, commodities, anything that tends to maintain or increase its value in nominal terms as the currency depreciates. They're not outsmarting the system so much as just knowing the rules of the game. And the people who don't know the rules, they save cash. They hold bonds that yield less than inflation. They work for 40 years, accumulate a sum that looks large on paper, and then discover in retirement that it buys far less than they planned. Not because they were foolish, because nobody told them the game was running. Here's the thought that's worth taking with you. Every generation gets the inflation speech after the crisis, after the 1970s stagflation, after 2008, after 2021. There's a moment of public attention, a spike in economic literacy searches, some headlines, some outrage, and then the rates come down a little, the urgency fades, and most people go back to not thinking about it. But the tax does not stop when the attention does. It runs in the background, every hour, every day, quietly